Hello and welcome back to Money Mindset Hub, your space for building financial confidence and navigating the world of investing. I'm your host, Raul Sofa. Have you ever felt like you're getting mixed signals, maybe from a friend, a potential job, or even the stock market? One minute, everything seems bright and optimistic. The next, there's a cloud of caution hanging overhead. Well, that's exactly the kind of environment we're stepping into as we kick off May 2025. Today, May the 1st, 2025, we're diving into a fascinating scenario. On one hand, the markets, particularly the tech-heavy Nasdaq and even the broader S&P 500, have been getting a significant boost. The fuel? Some really impressive earnings reports coming out of major technology companies over the past couple of weeks. Innovation seems to be firing on all cylinders, and investors are rewarding that. But, on the other hand, we're entering May. And in the financial world, May often comes with a whispered warning, an old adage: sell in May and go away. It suggests a period of historically weaker market performance during the summer months. So, what gives? Are we looking at a tech-powered rocket ship ready to defy historical trends? Or is this a moment of calm before a potential summer slowdown? That's what we're unpacking today. We'll look at the tech earnings driving the optimism, dissect that infamous sell in May saying, and most importantly, discuss what it all means for you, especially if you're just starting your investment journey or are curious about making your money work harder. Stick around, you won't want to miss this. All right, let's first talk about the good news. The engine that's been pushing markets higher recently, technology sector earnings. For those new to this, earnings season happens roughly every 3 months, where publicly traded companies report their financial results, how much revenue they made, how much profit, and often they give guidance on what they expect for the future. This past quarter's reports, particularly from some of the big names in tech, have largely exceeded analysts' expectations. Now, we won't dive into specific stock recommendations here, that's not our focus, but let's talk about the themes. We've seen strength in areas like 1. Artificial intelligence, AI, integration, companies showcasing tangible progress in integrating AI into their products and services, leading to efficiency gains or new revenue streams, have been viewed very favorably. Think about advancements in cloud computing platforms offering new AI tools, or software companies automating tasks for businesses. This isn't just hype anymore. Investors are seeing real financial impact. 2. Cloud computing growth. Despite concerns about economic slowdowns, the demand for cloud infrastructure and services continues to be robust. Businesses migrating their operations to the cloud is a long-term trend, and companies leading this space are showing resilience. 3. Digital advertising recovery or stability. After some choppiness, platforms reliant on digital advertising seem to be finding more stable footing, suggesting businesses are still willing to spend to reach customers online. 4. Hardware innovation. We're also seeing positive results from companies producing the chips and hardware that power all this technology, indicating continued demand for faster, more powerful devices and infrastructure. Why does this matter so much to the overall market? Well, technology companies make up a huge portion of major indices like the S&P 500 and especially the Nasdaq Composite. Think of it like a sports team. If your star players are all having fantastic games, the whole team's performance looks much better. When these tech giants report strong earnings and positive outlooks, it lifts investor sentiment across the board. It signals innovation, growth potential, and economic activity. Imagine planning a big group trip. If the friends who are organizing the transport, booking the accommodation, and planning the main activities all report back saying, everything's going great, better than expected, everyone else in the group feels more excited and confident about the trip, right? It's a similar dynamic in the market. Strong earnings from these leading tech firms create a positive halo effect. This recent performance is a powerful reminder of how innovation drives market cycles. We often talk about economic indicators like inflation or interest rates, and they are critically important, but the fundamental performance of companies, their ability to grow profits and adapt, is the bedrock of long-term stock market returns. The tech sector, despite facing challenges like increased regulation or competition, continues to demonstrate this adaptive capacity. This recent performance is a powerful reminder of how innovation drives market cycles. We often talk about economic indicators like inflation or interest rates, and they are critically important, but the fundamental performance of companies, their ability to grow profits and adapt, is the bedrock of long-term stock market returns. The tech sector, despite facing challenges like increased regulation or competition, continues to demonstrate this adaptive capacity. Let's talk about this elephant in the room: sell in May and go away. You've probably heard it. It's one of the most famous, or perhaps infamous, stock market adages. The idea is that the period from November to April tends to historically outperform the period from May to October. Therefore, the saying suggests investors might be better off selling their stocks at the beginning of May and returning to the market later in the fall, perhaps around Halloween. Where did this come from? Like many old sayings, its origins are a bit murky. Some trace it back to the old City of London customs when stockbrokers and merchants would leave the hot city for the summer. Others point to historical agricultural cycles. But statistically, looking back over many decades, there is some evidence suggesting weaker average returns during the summer months compared to the winter months in certain markets, particularly in the past. But, and this is a big but, does this historical pattern hold true today? And should it dictate your investment strategy, especially as a beginner or young professional? Let's break down why blindly following this adage is probably not a good idea. 1. It's an average, not a guarantee. History provides patterns, not predictions. There have been many May-October periods where the market performed exceptionally well, and many November-April periods where it performed poorly. Relying on seasonality is like betting on the weather based only on the month. You might be right sometimes, but you could also get caught in a surprise heat wave or cold snap. 2. Market dynamics have changed. The world is vastly different from when this adage originated. We have globalized markets operating 24/7, instant information flow, different economic drivers, like the tech we just discussed, and different types of market participants. Factors like central bank policies, geopolitical events, and technological disruption often have a far greater impact than seasonality alone. 3. Transaction costs and taxes. Selling investments and buying them back later incurs costs. You might face brokerage fees, though many are zero now, and, more importantly, potential capital gains taxes if you sell profitable investments held in a taxable account. These costs can eat away at any potential gains you might achieve by avoiding a slight downturn. 4. Missing out on gains. FOMO. What if May, June, and July turn out to be strong months? If you sold in May, you'd miss out entirely on those gains. Trying to time the market perfectly, selling at the absolute peak and buying at the absolute bottom is notoriously difficult, even for seasoned professionals. More often than not, attempts at market timing lead to worse results than simply staying invested. 5. Psychological toll. Constantly trying to jump in and out of the market based on seasonal trends or news headlines can be stressful and lead to emotional decision-making. Buying high out of fear of missing out, FOMO, or selling low during a panic. Think about it. The same market commentators who might mention sell in May today were just highlighting the strong tech earnings yesterday. The market often holds conflicting ideas simultaneously. The key isn't to pick one narrative and discard the other, but to understand both forces at play. Yes, historical patterns exist, but so do current, powerful fundamental drivers like corporate earnings and innovation. Think about it. The same market commentators who might mention sell in May today were just highlighting the strong tech earnings yesterday. The market often holds conflicting ideas simultaneously. The key isn't to pick one narrative and discard the other, but to understand both forces at play. Yes, historical patterns exist, but so do current, powerful fundamental drivers like corporate earnings and innovation. Okay, we've got strong tech performance pulling the market up, and this historical sell in May caution whispering in the background. What should you, as a Money Mindset Hub community member, actually do with this information? How do you navigate this noise? Here are some actionable insights focusing on building a resilient long-term approach. 1. Focus on your time. Horizon: are you investing for retirement in 30 years? A house, down payment in 5 years? Your investment strategy should align with your goals and timeline, not seasonal market chatter. Short-term fluctuations, whether driven by earnings or adages, matter less the longer your investment horizon. Remember, investing is generally a marathon, not a sprint. 2. Stick to your strategy or create one. Do you have an investment plan? If not, now's the time to think about one. This includes defining your goals, understanding your risk tolerance, how comfortable you are with potential losses, and deciding on an asset allocation, how you divide your money between different types of investments like stocks, bonds, etc. If you have a plan, stick to it. Don't let short-term news, good or bad, derail your long-term strategy. 3. Embrace diversification. We just talked about how strong tech earnings are lifting the market. That's great, but it also highlights the importance of not putting all your eggs in one basket. Diversification means spreading your investments across different sectors: tech, healthcare, financials, consumer goods, etc. Different geographic regions, US, international, and potentially different asset classes like bonds or real estate, depending on your strategy. This helps cushion the blow if one particular sector or region underperforms. Even if tech is flying high, ensure your portfolio has exposure to other areas too. 4. Consider dollar cost averaging, DCA. Instead of trying to time the market like selling in May, consider investing a fixed amount of money at regular intervals, e.g. monthly or bi-weekly. This is called dollar cost averaging. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this approach can smooth out your average purchase price and reduces the risk of investing a large sum right before a market dip. It takes the emotion and timing guesswork out of the equation. 5. Stay informed, not overwhelmed. It's good to understand market trends, like the impact of tech earnings, or the context behind sayings like sell in May. Knowledge builds confidence, but don't get glued to financial news 24/7. This can lead to anxiety and reactive decisions. Check in periodically, understand the big picture, but trust your long-term plan. 6. Reevaluate, don't react. Use market events not as triggers for panic selling or buying, but as prompts to review your own situation. Do your goals remain the same? Has your risk tolerance changed? Is your portfolio still aligned with your long-term plan? Make adjustments based on your life, not just the market headlines. Ultimately, the current situation, strong tech versus sell in May, is a perfect example of why a disciplined long-term approach focused on fundamentals and diversification is so crucial. It allows you to appreciate the positive news without getting carried away and acknowledge potential headwinds without panicking. So, wrapping up our stock market update for May the 1st, 2025. Key takeaway. The market has recently seen a boost, largely thanks to impressive earnings reports from major technology companies showcasing strength in AI, cloud computing, and overall innovation. This highlights the power of fundamental company performance. Key takeaway. Number 2, we've entered May, bringing the old sell in May and go away adage into focus. While based on some historical patterns of weaker summer performance, it's not a reliable predictor for today's markets and generally isn't a sound basis for making investment decisions due to changed market dynamics, costs, and the risk of missing gains. Key takeaway. Number 3. For most investors, especially beginners and young professionals, the best approach is to focus on the long term. Stick to your investment plan, stay diversified, consider strategies like dollar cost averaging, and don't let short-term noise or historical sayings derail your financial goals. Building wealth through investing isn't about perfectly predicting every market turn. It's about understanding the landscape, having a solid plan based on your own goals, and exercising the discipline to stick with it through different seasons, both the sunny periods of strong earnings and the potentially cloudier forecasts suggested by old adages. It's about developing your money mindset. What are your thoughts on the current market? Are you focused on the tech boom, or does the sell in May idea make you cautious? Let us know in the comments below. We love hearing from the Money Mindset Hub community. If you found this episode helpful and insightful, please give it a like. It really helps support the channel. And if you haven't already, make sure you subscribe to Money Mindset Hub and click that notification bell so you don't miss our future episodes, where we'll continue to break down complex financial topics into clear, actionable insights. Thanks for tuning in today. Keep building that knowledge, stay disciplined, and I'll see you in the next episode.